Okay, friends, we made it 1 week into earnings season, and results were pretty good. Let's take a look at them on the weekend update. Okay, friends, let's talk about earnings kickoff. Here's what you need to know. First up, earnings season starts with a strong showing from the banks, American Express, and Netflix. So what we're going to do today is we're going to delve into earnings season and see what these companies and industries have told us about the U.S. economy. First up, though, let's take a look at the market, same way we've always been looking at it. Red is the S&P 500, orange is the 50-day, purple is the 200-day. What do you notice? Well, yet another week of me saying just about the same things. We're at all-time highs. We've lifted to all-time highs. We continue to push even further here. And technically, the market just continues to look better and better. The 50-day moving average is moving up and starting to meet us where we are, and that's good. I don't like, too much separation between us and the 50-day. That's where painful things can happen, so it coming up looks good. We had our golden cross a couple weeks ago. Even the 200-day moving average now has a nice upward slope to it, and I expect all of these things to continue trending higher. That's that thesis that I've had that the longer that we trend, the more we will trend because the market has inertia. So as we keep trending higher, my expectation is it's going to keep on going. Now, we are overdue for a breather, and we're certainly going to get a breather at some point, a consolidation period in this market growth. But at least for right now, technically, this looks like a very strong uptrend. And even if we took a breather, that wouldn't change anything. Let's talk about earnings season. I'm going to start off with the banks. Banks put in some really good showing this year. So what I'm showing you here is key financial sector earnings reports, or at least this quarter. This was 7/15/2025. And I just wanted to show you just kind of a smattering of the banks and how it went. JP Morgan, Wells Fargo, BlackRock, Citigroup, Bank of New York. Almost all of them across the board with sales and earnings per share beats. And a large part of what's driving this is the deregulation, is the way the bank regulators look at risk capital. These banks are all pursuing different strategies, some through trading like JP Morgan. Wells Fargo says, hey, we want to start lending like a regular bank again. So there's a lot of good stuff here. The only fly in the ointment was BlackRock, which missed on sales, but their miss was related to one very large client pulling out during the quarter. And so it's not even really a read on weakness in what BlackRock offers. Again, of course, BlackRock being the largest producer of investment product. But it looked really good from the financial side of things. What we didn't see any sort of distress coming from Liberation Day. We didn't see banks saying, hey, we're getting really nervous about this economic environment. What we saw was banks look like they think that, the good times are going to continue for a little bit longer, and they're looking to lean into it. So we saw aggression from the banks. They want to play offense here. I think that's pretty good. That should bode well for the economy. So good stuff in the financials. Next up, of course, we had American Express. American Express is, the charge card, but primarily skews maybe more towards the affluent. And they put up some pretty great numbers. Revenue 9% year over year, earnings per share up 17% year over year. Card member spending up 7% year over year at an all-time high. So this is a really good read on the economy. We can at least say, okay, how are the affluent people doing? No surprise, the affluent are doing well. The affluent always do well. But what I will say is, $416 billion in member spending, up 7% year over year. That doesn't look like recession to me. It doesn't look like slowdown. Looks like strength. The underlying economy looks like it's doing really well, at least in that top slice. One of the most interesting things, though, I think on the American Express call was they said travel spending seems to be slowing. And this is pretty interesting. I think we finally reached, we had this COVID period, and then we had all this revenge travel, and then we had all this, work from home sort of, extended travel stuff going on. I think we're finally traveled out. I think we've finally gone on all the vacations we want to go on. And more importantly, because of what the dollar is doing, it's making those international travel, those vacations are just getting more and more expensive as the dollar is down 10% this year. We're actually going to talk about that when we roll to Netflix. Netflix, I'm going to use Earning Whisper's conference call summary because I thought it was pretty good here. We raised guidance, that's good, but this was all due to currencies. And so what I want to highlight on the Netflix call, so Netflix was doing great, right? Ads were good, earnings were good. Netflix is just firing on all cylinders. I think it's a fantastic, fantastic business. But the most important thing for me was currency translation. So back in the day, they used to say, hey, you've got to have domestic and international stocks. And if you do that, you blend yourself and, maybe you can protect yourself if US catches a cold, but the rest of the world doesn't, sort of thing. I've never really believed that because I think it's something like 60, maybe 40% of revenue. It's either 40 or 60. It's one of the two. But a large portion of S&P 500 revenues come from overseas. And so Netflix here in the US, they're saying, hey, we're raising guidance due to currencies. And so what that means is when people in the UK, pay with pound sterling, when people in the Eurozone pay with the euro, anywhere that Netflix is, if you pay with a currency, when they translate that back to dollars, the dollar is down 10% this year. And so what that means is all of those monetary flows overseas are now 10% higher. And so I think we're going to see this through a lot of the large multinational companies, the Mag 7, as it were. I think all of them are going to come in really strongly off of the weakness in the US dollar. For domestic businesses, if you're in the US making and selling to the US, it's not going to impact you. But for the big boys, this should be a nice boost. I've left some Trump slides in here. These are the slides from last week on tariffs. Again, Trump is playing hardball with tariffs. And the Trump market, is going to be sharp peaks and V valleys. And I leave this in here only to say, once we get through this era of good feelings, I think we'll be back in a Trump market again. But what does it all mean, earnings kickoff? Well, earnings season started off with on a strong foot in week 1. Banks did well. American Express told us the consumer is still spending. Netflix earnings showed the power of the falling dollar. And I think we're going to see this in the big boys, and that's going to be good for the index. American Express highlighted softness in travel, and that's an interesting thing to note. So I'm noting it. So there you go. That's earnings kickoff. It was a great first week in earnings. Next week, we start to get into some of the more market moving names, and we should get a lot better read on the economy as we move forward. So there you go. I'll see you next week. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.